Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, inflation in the CPI, why your money buys less. And, if you take a crisp $100 bill today and you just lock it in a dark drawer, you might feel a real sense of financial discipline.
Oh, yeah, it feels responsible.
Right. You think, hey, I am saving. But the reality is, you've just placed your wealth on this invisible treadmill that is permanently running backward.
That is perfectly put.
So today, we are tearing down the mechanics of that invisible treadmill. We're doing a deep dive into research from the CFA Institute, Investopedia, and looking at some economic methodology data.
Yeah, to explain not just what inflation and the consumer price index actually are, but how the underlying engine of those price mechanics actively degrades uninvested capital.
Exactly. Okay, so I'm going to stick with that $100 bill in the drawer for a second, just to make the mechanics super concrete for you.
Let's do it.
If you stash that $100 away today and inflation sits at, let's say, 2%, next year, you pull that piece of paper out of the drawer.
And it still looks exactly the same.
Right. Benjamin Franklin is still staring at you. The nominal value still reads $100. But that's the trap, right? It's the illusion of nominal safety.
Yeah, because the actual economic utility of that bill, its ability to buy milk or pay rent or put fuel in a car, that has shrunk to $98 compared to the previous year.
Right. You lost $2 of invisible value while the money was literally locked in the dark, doing absolutely nothing.
Which is exactly why sitting in cash isn't a neutral position.
Mm-hmm.
When we look at the CFA Institute's framing, they emphasize that holding cash is an explicit decision to accept a guaranteed loss in real terms.
Because doing nothing means you're just moving backward on that treadmill.
Exactly. And, we often hear inflation defined simply as a sustained increase in the general price level of goods and services over time.
Which sounds very academic.
Right. But for anyone managing a portfolio, leaving the definition there completely misses the point. The core danger for you, the investor, is the erosion of purchasing power.
And purchasing power is just the actual physical volume of stuff you can buy, right?
Yeah, the actual volume of goods and services your capital can extract from the economy.
Okay, so since we know exactly how much value is being lost, like that 2% we just talked about, someone clearly has to be keeping track of all this.
Oh, definitely. Economists and central banks, they require a highly standardized mechanism to measure the exact speed of that treadmill.
Right.
They have to quantify the evaporation rate across an entire nation's economy. And that mechanism is the Consumer Price Index.
The CPI.
Right, widely known as the CPI.
Yeah.
But the CPI doesn't just look at the raw price of everything in the world all at once.
That would be impossible.
Totally impossible.
Yeah.
So the methodology relies on this concept called the market basket, which basically attempts to model the financial reality of the average household.
The market basket. Okay, so when I look at how this basket is constructed, what really stands out to me isn't just the sheer volume of items. It's the weighting. It's not just some random assortment of things we happen to buy.
No, not at all. The weighting is the entire structural foundation of the index.
Right, because if the price of housing goes up by 5%, that moves the needle on the CPI way harder than if the price of, toothpicks goes up by 5%.
Exactly. Simply because a vastly larger portion of your paycheck goes toward keeping a roof over your head than buying toothpicks.
Right. The basket is weighted to reflect actual consumer expenditure patterns.
Yeah, statisticians aren't merely tracking price tags, They're tracking the proportion of human survival costs.
Yeah, survival costs. That's a heavy way to phrase it, but it's true.
It is. And to figure out those exact weights, agencies conduct these massive consumer expenditure surveys. They analyze exactly what people are buying.
Down to the penny, I'm sure.
Basically, yeah. They look at housing, transportation, food, medical care, apparel, and they assign each category a specific percentage slice of the overall basket.
Based on real-world spending habits.
Exactly. And then comes the data collection phase, which is just an enormous logistical undertaking.
Oh, I bet.
Every single month, data collectors are physically checking prices on tens of thousands of specific items at retail stores, service establishments, rental units all across the country.
Just to see how the cost of that specific weighted basket is shifting.
Yep. And crucially, they have to adjust those prices for any changes in quality or features, which we'll actually get into a bit later.
Yeah, that quality adjustment part is wild. But, okay, here's where it gets really interesting for the math side of things.
Ooh, lay it on me.
To translate all of that raw, messy data into the single clean CPI percentage we see on the news, The logic relies on a relative scorecard.
Right, an index.
Right. So rather than trying to calculate the total literal dollar amount of this massive national grocery cart, the statisticians just pick a starting line, a base year. And they assign that base year basket a nice, neat index value of exactly 100.
Makes the math much cleaner.
Exactly. So if they check the exact same weighted basket, say a few years later, and find that the total cost is 10% higher, the new index value sits at 110.
Right.
So it's super easy to calculate.
Yeah.
You just take the desired year 110, divided by the base year of 100, and multiply by 100, and boom, you get 110.
Right, a 10% increase in prices. It's an elegant way to instantly communicate the relative change in the cost of living without getting bogged down in individual price tags.
Exactly. But here's the thing. While the math is super clean and straightforward on a spreadsheet, people's real-world feelings about inflation are usually, well, pretty negative and messy.
Oh, absolutely. Everyone hates inflation.
Right. Which brings us to the big misconception. Because we naturally assume inflation is always this purely evil economic villain.
Yeah, that's the natural instinct. You just wish prices would stay flat forever or even go down.
But the CFA Institute data argues something highly counterintuitive here.
It does. It points out that a moderate level of inflation is actually beneficial for the economy.
Wait, really? So you're telling me that paying more for my groceries is actually, like, good for the economy?
I know it sounds crazy, but you have to think about the alternative, which is deflation, a broad, sustained drop in prices.
Okay.
Deflation actually breaks the fundamental incentive structure of a modern economy.
How so?
Well, to understand why, you have to look at your psychology as a consumer in a deflationary environment. Consider a major purchase, like a new car or a big home appliance.
Okay, I'm with you.
If you know with absolute certainty that prices are falling by 2% a year, your cash is gaining purchasing power just by sitting in your checking account.
Oh, right. So I would have zero urgency to make the purchase. I would just wait.
Exactly.
If the car is going to be noticeably cheaper in 6 months and my money is becoming more valuable every single day I do nothing, the most logical financial move is to just hold on to my cash.
Right. And when millions of consumers make that exact same logical calculation simultaneously, the velocity of money drops to zero.
Because nobody is spending anything.
Spending completely freezes. Businesses see their revenue plummet, so they immediately halt expansion plans. They start buying inventory. They stop hiring.
And eventually they start laying people off.
Exactly, which creates a vicious downward spiral. Those laid-off workers now have less income, meaning they spend even less, which drives prices down further, causing more layoffs.
Wow, it's a self-feeding loop that destroys economic output.
It is. And this is precisely why central banks actually target a moderate, steady level of inflation, usually around that 2% mark.
Okay, so it's not an accident.
No, it is a highly intentional macroeconomic tool. Moderate inflation acts as a sort of psychological cattle prod.
A cattle prod. I like that.
Yeah, it provides a built-in decay rate on uninvested cash to force capital off the sidelines. You are mathematically penalized for hoarding currency.
So you're incentivized to either spend it on goods today, keeping the engine turning, or invest it into businesses and assets.
Exactly. It provides the capital necessary for innovation and growth. But, as the CFA Institute is clear to point out, this is a delicate balancing act.
Because high inflation is terrible.
Right. Once inflation crosses from moderate to high, it stops being a cattle prod and starts being a wrecking ball. High inflation is entirely destructive.
It destroys consumer confidence because paychecks just can't keep up with the cost of daily survival.
Yeah, and it makes long-term business planning virtually impossible. Plus, it rapidly erodes the living standards of anyone on a fixed income.
But hold on, going back to the CPI for a second. If the CPI is just tracking those consumption items, the groceries, the gas, isn't it missing a huge part of the picture for an investor?
Oh, I'm so glad you brought that up. Yes, it absolutely is. And this is where we get into the limitations of the CPI.
Right.
Based on the Wikipedia data, the CPI is explicitly not a perfect measure. Its biggest blind spot is that it entirely ignores savings and investments.
It only focuses on household consumption.
Exactly. It tracks the things we use, up the food, the fuel, the haircuts. It explicitly ignores the purchase of investments and assets.
Which is a massive blind spot for anyone trying to build wealth. I mean, from an economic modeling standpoint, I get the rationale.
Right.
Buying a share of the S&P 500 or putting a down payment on a house isn't technically consuming a good. It's a transfer of wealth into an asset.
Exactly. It's an asset swap.
But for you listening, Trying to map out your financial future, ignoring asset prices, makes the CPI feel totally disconnected from reality.
The disconnect is profound. I mean,
Yeah.
you can easily live through a decade where consumer inflation, the cost of your milk and gas remains relatively tame at 2%,
Right.
but asset prices, the cost of stocks, bonds, and real estate, are inflating at 10 or 15% annually.
Wow. Yeah.
So if you are only indexing your financial goals to the CPI, you will find yourself falling drastically behind the actual cost of acquiring wealth. Your daily survival costs are stable, but your retirement costs are hyperinflating.
That is terrifying. And beyond just ignoring assets, the basket also struggles with real human behavior, right?
Yeah. The CPI model assumes a rigid consumption pattern, but consumers are dynamic.
The classic substitution effect.
Right.
Like, if a severe supply chain issue causes the price of beef to double overnight, families don't usually double their grocery budget just to accommodate it.
No, they adapt.
They switch their Friday night dinners to chicken or pasta.
Yeah.
So their actual out-of-pocket grocery bill doesn't rise nearly as much as the fixed CPI basket predicts.
Exactly, because the CPI is still heavily weighting beef under the assumption that everyone is buying it at the old rate. It creates a perpetual lag in the data.
So because the CPI isn't perfect, and because inflation is constantly threatening our purchasing power, how do we actually protect our money? We can't just cross our fingers.
No, you have to play active defense. And Investopedia outlines some great strategies for this, primarily using inflation-indexed instruments. Utilizing these instruments shifts you from a passive victim of monetary policy to an active manager of your own purchasing power.
And the big one they highlight is TPS, right? Treasury Inflation-Protected Securities?
Yes. TPS are the primary tool here. They are used by massive institutions and everyday retail investors to shield their portfolios.
Okay, to understand why TPS are necessary, I think we should probably look at the flaw in a traditional fixed income bond first.
That's a good place to start.
If I buy a standard government bond that pays a fixed 3% interest rate every year, and inflation suddenly spikes to 5%.
Then your real return is negative 2%.
Right. I am safely and reliably losing purchasing power. It's like, think of a standard bond like a fixed-length ladder.
Okay, I like this analogy.
If the water level representing inflation starts rising rapidly, the ladder stays exactly the same size. So eventually the water goes over your head and your purchasing power just drowns.
It's a great visual, but based on the Investopedia breakdown, TPS operate quite differently. They're more like a ladder attached to a floating dock.
A floating dock.
Yeah. With TPS, the U.S. Treasury actively adjusts the underlying principal value of the bond upward in tandem with the CPI.
Wow.
So as the water level of inflation rises, the rungs of your ladder essentially stretch upward.
So your principal is actually growing.
Exactly.
Yep.
And because your fixed interest payments are calculated based on that continually rising principal amount, your cash payouts increase as well.
That's amazing. It provides a mathematically guaranteed shield, ensuring your investment stays above the surface of inflation.
Yep. But, the market doesn't hand out free insurance.
Naturally.
Because TPS perfectly hedge against CPI increases, the initial yield you receive when you purchase them will be slightly lower than a standard, unprotected treasury bond of the exact same maturity.
So you are basically paying a premium for that floating dock mechanism.
Essentially, yes. It's a calculated bet on the future trajectory of the CPI relative to the broader market's expectations.
Which brings us right back to the integrity of the CPI itself, which we've already established is kind of flawed.
Very flawed.
So let's pull all these threads together and rapidly synthesize the key takeaways from today's deep dive so you can apply this framework to your own portfolio.
Sounds good.
First, inflation constantly eats at your purchasing power, and it's measured by the weighted CPI basket. It is an active headwind against your uninvested capital.
Right. And second, moderate inflation is actually an intentional driver of economic growth. It acts as that cattle prod we talked about, even if it feels painful at the register.
Exactly. Third, the CPI is a flawed tool. It completely ignores investments and savings, focusing only on household consumption, and it lags behind real consumer behavior.
Which leads to the final takeaway. Because of these flaws and because cash erodes, investors must actively defend their money using tools like TPS.
Exactly. But before we sign off, I know you had a really provocative final thought you wanted to leave the listener with, specifically regarding something we touched on earlier, the quality adjustments in the CPI.
Yeah, this is the hedonics concept. It's something to really ponder. The source notes that the CPI actively adjusts prices downward based on changes in quality or features.
Right.
So who exactly decides how much a new feature is worth to your life? I mean, if your new phone costs $100 more this year, but it has a slightly better camera, the statisticians might say the real price didn't go up because you got more utility.
Which lowers the official CPI.
Exactly. But does that mask real inflation? I mean, does a better camera truly offset the fact that you now have less physical cash to spend on groceries?
That is such a good point.
It's just something to think about next time you're analyzing the official inflation rate against the very real receipts in your own wallet.
That's all for this weekend's Deep Dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.